Welcome to a JSServices presentation on structure bias. In this video, I will go over JSServices structure analysis as the basis to standardize a trade plan and demonstrate how following our analysis to optimize your trading tactics can make them more effective. In part 1 of this series, the focus will be on pivotal market structure bias for both trend and non-trend trading environments. What is structure bias? The price map represents a price framework of the market state and is JSServices structure analytics. The R level is an action qualifier that identifies the specific price level where the bias of the trade period shifts from positive to negative and vice versa. This sentiment bias further defines the market state characteristics by its position on the price map and is the level with the most influence for the trade period. To be clear, when the R level position on the price map is added to the characteristics of the state, it equals the market structure bias and provides a clearer picture of the context of the current condition, so trading methods can be aligned with these facts. There are 9 R level positions on the price map. Each structure position has its own skew and influence on price behavior regardless of the state condition. The R level will always be on one of these price map qualifier levels and can be used to standardize a trading method based on a specific market structure that complements a trading approach or tactic. The R-level structure bias, when viewed in the context of the market state, provides insight to the expectation of the condition. For example, the R level below the market in a bull trend is in alignment with the characteristics of a positive trend state, having a positive sentiment bias. If, however, the R level is above the market in a bull trend state, sentiment is negative, and although the market is in a bull trend, there is a negative or corrective expectation. The structure bias really narrows the condition with a specific focal point to standardize your entry tactics. The Market Structure Bias commentary is located in the Playbook Strategy tab, which outlines the details of the environment, making it easier to anticipate opportunity and maintain conviction to a trade. By aligning your tactics to the nuances and tells of a specific structure bias, you standardize your method and create a more systematic approach to trading. Each tile on the market color grid identifies the JS market symbol, its market state type, signature tag, and the R equals price map position, offering an at-a-glance overview of the market structure bias for each symbol on the grid. The procedure each session is to know the facts associated with the market structure bias so your tactics can be aligned. For example, if your method is to trade with momentum, and you particularly like pivotal states, then the R level equal to the directional is the structure bias that identifies pivotal conditions where breakouts may occur. The most complementary characteristics of an R equals directional structure bias is that it can produce big breakout sessions. The downside to this structure bias is that it can also produce a sideways rotational session as the market coils to prepare for a breakout. Using December 19, 2016 as an example, we'll identify 8 symbols with an R equals DIR structure bias. 4 symbols in a non-trend type neutral digestion state, 2 in a trend type condition, and 1 index with both futures and the ETF in a signature trend acceleration market structure bias. To start, we need to know the facts associated with the market structure bias. First, we'll take a look at a non-trend type neutral digestion with R equals directional structure bias. The market state commentary sets the foundation for the condition. If we are painting a picture of the environment, the market state is the base coat. A neutral digestion state is typically viewed as a sideways trading environment. But a characteristic of a neutral digestion is that it can also be a precursor to a breakout, as the coiling action of the neutral state will build power. Typically, a sign that the sentiment is going to change from neutral digestion to trend is signaled by an early session trend move with no break in the positive or negative structure. A simple moving average is a great tool used to identify a possible breakout day with the expectation that if the market is going to scale up or down, it will maintain a trade above or below the moving average. This is a characteristic of the state condition. The Market Structure Commentary in the Strategy tab emphasizes this fact by identifying when the sentiment bias is in the middle of the critical range and signals the potential turning point in the current market state. This is a dynamic signature state with the potential to spark a low volatility one-way trade for the balance of the session, or a sideways rotational trade around the critical range midpoint. Look for the market's ability to build structure or not as the tell. Now that we know the facts, we want to standardize our method to them. As a pivotal momentum breakout trader, we are interested in a buy or a sell R breakout hedge strategy theme. This is our best strategy for this structure bias, or one that has the most value to us, as entering at the R level will have the best risk-reward associated with an opportunity. A buy UP or sell DP breakout of the critical range are also valid strategies, as they are in alignment with a R breakout hedge theme, but will be of lesser value. We can standardize our size management by ranking opportunity in terms of units under the following guidelines. For a 3-unit max size management system, an optimal strategy theme trade would be 3 units. This means that if an optimal trade is accepted, it must be 3 units. Even if you think it should only be 2, by standardizing this process it must be 3. Similar to playing blackjack, when you are dealt a hard 11, you need to double down. In trading, when your tactic signal is in alignment with the market structure bias in an optimal strategy theme, you have to trade your max size. You don't trade max size when you feel good. You trade it when your tactics align with the optimal structure bias. If it's a hedge theme, it should be a 2-unit trade. Hedge strategies are themes that look to participate in potential transitional shifts in state, when a market breaks structure of the current condition. Shifts in state can be dramatic and provide significant opportunity, but the lack of clarity of what state the market is transitioning into balances the reward and makes this a 2-unit trade. Other opportunities that are not defined in the playbook strategy, optimal, or hedge themes, if aligned with the context of the state and the structure, using this size management approach would be a 1-unit trade. So in this example, a buy UP or sell DP breakout is valid, but is only allowed 1 unit. By standardizing your size management, you remove the emotion and align your leverage with the probabilities and the best risk-defined opportunities. As a practical application, the bund is in a neutral digestion R equals directional market structure bias and produced a textbook breakout session. It's important to know what a textbook trade looks like, as this is what you should be looking for in every trade you put on. By anticipating the price action to be perfect, it's easy to identify when it's not, alerting you to the fact that this is not a perfect scenario and tactics should be adjusted. As the session starts, a key tell to a potential breakout is that the market starts trading around the directional R level. This is the first fact that produces a "what if the market breaks out today?" The fact that the market is trading above the directional R gives it a positive bias, and the fact that the market is traded above the 162.27 CR plus confirms that bias. It's normal for price action to rotate or churn around the R level in this structure bias. When it does so with a specific bias versus trading back and forth through the R level, it adds the likelihood of a breakout in that direction. Economic reports should be taken into consideration, as it's unlikely a market will commit to a direction until after a release and will more likely digest in front of a figure. Once it does commit, the key tell is the fact that the market is holding structure, and if so, then the trend should be expected to continue into the close. Clarity of the current condition is achieved by observing price action within market structure in the context of the state. Price action is simply observing if the market is holding positive or negative structure by making higher move highs or higher move lows, or lower move lows and lower highs. If it can do this, then it is trending and holding price structure. If not, then structure has been broken and the market is in a non-trend condition. As a breakout trader, a break in the first structure point is a tell that the trend may be over, and a break in the second structure confirms that it is. Market structure is defined by the PriceMap framework. Instead of peaks and troughs, it is viewed more like a ladder or a staircase, where once a PriceMap level is taken out, it should continue to climb to the next level on the PriceMap. The inability to climb higher for a positive trend, successive higher PriceMap levels, is a signal that there is a break in market structure and a decrease in the expectation of the market's ability to trend. Market structure always trumps price structure in terms of trade expectation, with the second market structure level break as the final confirmation of a change in trend. The market structure bias is made up of the state and structure, and the structure is made up of the sentiment bias R level and the critical range. Where the sentiment bias skews the state expectation, the critical range is the hard boundary that outlines the structure that defines the state. This is done with two price points, the UP, upside pivot, and DP, downside pivot. The critical range provides insight to when shifts in state will occur by identifying where they will occur. The critical range is broken down into directional and validation levels. The upside pivot is the upper boundary or the resistance level used to signal positive changes in market state characteristics. This level forms the top of the critical range and is the market structure point that must be breached to confirm an upside breakout strategy from the DIR. The downside pivot, or DP, is the lower boundary of the support level used to signal negative changes in market state characteristics. This level forms the bottom of the critical range and is the market structure point that price must break below to confirm a sell breakout strategy from the DIR R level. The DIR directional is the midpoint of the critical range and typically a classic pivot point that identifies the directional bias. When the R level is equal to the directional, it identifies the focal point for the initiation of a new market trend move. Validation levels confirm change in market state. The CR plus and CR minus define the midpoints, not necessarily symmetrical, between the UP directional and the DIR and the DP. These levels validate momentum shifts from the directional and should be used to confirm a directional R bias. So once the CR plus is breached, it confirms a positive R level bias up to the UP. The CRX plus and CRX minus, or critical range extreme positive and negative, define the boundary extremes of the upside pivot and downside pivot directional levels, which validate or deny a UP or DP breakout. Once price action breaks out above or below the UP or DP, it must breach the CRX plus or CRX minus to confirm that the breakout in the market structure is true. Both these validation levels can be used as triggers to apply leverage or initiate a new position that is in alignment with the DIR-R breakout strategy theme. The critical range provides a structured framework to observe price action and standardize trade methods. Observing price action within market structure provides clarity to what strategy theme is dominating the session, so you can align your trading tactics. If you come into mid-session and the market has been holding positive structure all session and has broken out above the upside pivot, confirming a buy breakout and a hedge strategy theme, then aligning tactics to this fact, which is that price action is more likely to continue higher rather than thinking that the rally is overdone and hoping for it to break because you missed the original buy opportunity at the DIR-R level. Trading tactics are standardized with JS PriceMap analytics can be optimized using market metrics. Market metrics are divided into reward expectation, or the average PriceMap distance, APMD, and risk and position management with the VAR variance, AD alert distance, and MSD maximum stop distance. The market metrics for each symbol can be found in the Market Summary Report, which can be accessed through the Desktop File pull-down menu, or from the JS Sheet XLS file, which is located on the C drive in your Users Documents JS Services directory, which is formatted for dynamic linking. The metrics are also displayed in JSServices third-party vendor integrations, either on the chart or in historical market depth display. The average price map distance, or APMD, identifies the price segment distance that the market is trading in. For a breakout strategy, the expectation is for a ×2 APMD move. The reason is that breakout trades occur less frequently, but when they do, they normally produce a 2 or 3 APMD move. During an event, 4 or 5 APMD moves are common. When standardizing a breakout strategy, 2 APMDs should be the objective, with 1 APMD the minimum target for a multi-unit trade. VIR variance metric defines the variance surrounding the price map level that should be considered at the level. This metric can be used for risk management, but its primary function is to identify the optimal entry area. The VIR is also the signal acceptance threshold for a minor level. The alert distance defines the signal acceptance area surrounding a directional or major price map level. This metric also qualifies the structure thresholds for stop placement and conditional alerts for the playbook strategy themes. As a practical application, when price is greater than the DIR plus alert distance, it signals that the bias has turned positive. Price structure from the current or prior session that is in alignment with the price map level or market metric can be used to optimize stop placement. In this example, after price is moved above the alert distance, limit orders can be placed at the directional R plus the alert distance and plus the variance, and stops can be placed on the opposite side using the negative variance and the negative alert distance for the stops, and then limit orders can be used for 1 times an average price map distance and 2 times average price map distance, again using the VIR and alert distance metrics in front of the price map figures. This is a 2-unit trade because it's a hedge strategy theme, but a breach of the CR plus variance is a valid add-on buy signal, which would have a maximum size of 1 unit. The add-on stop is placed below the CR plus variance metric, with the target limit at either 1 or 2 APMDs. Because we're in a breakout, we're looking for a breakout strategy, so we're going to go for it. When the add-on is filled, one of the original position's trail stops should be adjusted up so that the position remains positive if the add-on is stopped out. The trail stop adjustment is also warranted because the trade is looking for only 1 APMD, and as the market approaches it, we don't want to get our risk-reward skewed, so we need to adjust our stop up. The market structure's trail stop in a textbook transitional hedge strategy theme breakout will hold and continue into the close of the session. This is a characteristic of a neutral market state, and it's an example of that definition. Note that the buy UP breakout was also a valid strategy in this example, and it paid out for 2 APMDs. Corn is another market in a neutral digestion R equals directional market structure bias, but it generated a sell R breakout strategy. On the open, corn generates a negative signal by trading below the alert distance. The market is gapped lower with the previous session price structure high and close above the directional R alert distance. This must be considered as the potential high point for any squeeze and should be used in consideration for stop placement and risk management. In this example, because price structure is indicating that there might be more risk, it is valid to standardize an alternative entry method to wait for price action to fill in some of the overnight gap and then enter the second unit with confirmation, spreading the limit order and stops. A neutral digestion state with the R equal to the directional structure identifies a unique condition. Typically, what has happened is that the digestive action is coiled and reached its focal point at the directional. When the R equals a directional, it's a tell that the coiling may be over and the market is ready to break out. If the digestive action has occurred over a few sessions, it's more likely to produce follow-through in the following session as the market is transitioning out of neutral and into a new state. It is especially true if the breakout signal did not attain 2 APMDs, as it should be expected to do so sometime during the following session. Soybean meal was also in a neutral digestion DIR structure bias and had similar performance to corn, generating a negative signal on the opening and producing a sell R breakout strategy that played out over multiple sessions. The SPY Spider ETF was another market with identical market structure bias, but had more of a rotational outcome after generating a positive signal by moving above the alert distance. Using a standardized entry of the alert distance and DIR above the directional R as entry limits, only the alert distance limit would have been filled on the initial entry. In this instance, having only one unit on in a 2-unit trade, it's better to use the 2 APMD as a target, although a 1 APMD target is valid. Price structure off the open, just below the directional alert distance metric, provided good alignment to place a stop below that price point. An add-on trade above the 225.75 CR Plus is valid. However, since we only have one unit on from the R level, it makes the trade riskier. In terms of standardized size management, if we only have one unit on from the best entry, any other entry that is not at the best spot should have less size. So an add-on at the CR Plus validation level would need to be a half a unit or not taken. Once price action breached the market structure above the CR Plus variance, the trail stop can be moved up below the price structure below the CR variance metric. If the market's going to produce a textbook breakout, it should hold positive structure and market structure. If it does not, then it's not textbook and may not be ready to break out. The original limit at the VAR remains valid, but the size for the new trade should match the original position with stop placement at the same place under the alert distance metric. The profit limit, however, should be placed at 1 APMD instead of 2, as the upside potential expectation has been diminished with the textbook scenario being broken. As price action again attempts to build positive structure by breaching the CR Plus VAR metric, the trail stop should be raised below the CR Plus VAR metric price structure. The trade did not work but was profitable using a standardized position management system. After the first break in price structure, the textbook scenario was negated, but the hedge theme remained in command because the second market structure level below the DIR alert distance was not broken. Recognizing what theme is in command kept trading on the right side of the market in what turned out to be a non-event session. The R equal directional structure bias for a bull and bear trend examples also played out on December 19th. Again, know the facts associated with the state condition, as well as how the DIR structure bias will influence it. There are both optimal buy R fade and hedge strategies, sell R breakout, associated with the DIR level structure bias. If, however, we are only interested in pivotal breakouts, then the hedge theme or the sell R breakout is more interesting, as it will signal a potential transitional shift. The market state condition for a bull trend is typified by the market that continues to make higher move highs and higher move lows, or positive structure. As long as the market continues to hold structure, further gains should be expected. A market in a bull trend signature state with the R level equal to the directional defines the turning point for the current positive momentum. The market is in play and the R level will either confirm or deny the current bull trend. A break below the R level signals a break in the positive market structure and a shift into a more digestive state. Expect difficult conditions with false momentum signals. Only below the downside pivot is there the potential for a corrective turn. At the start of each session, identifying what theme is in command is key. By using a fact focus in this structure bias, it's clear that the market cannot be in an optimal theme, as it is open below the directional R level. This is knowledge, as it's a fact that for a market to be trending positive, it must hold positive market structure. By trading below the R level in a bull market, it confirms a break in structure, negating the optimal theme. In this scenario, the market is either going to have a hedge theme or sideways non-event session. This is the same every session. There are three outcomes: optimal theme, hedge theme, or non-event. If we know the optimal theme is not true, then it's more likely to either have a hedge theme session or a non-event. Tactics and awareness should be aligned to this fact. In this example, I've incorporated the maximum stop distance as the maximum amount of risk for a sell R breakout strategy. Sell entries at the alert distance and variance will have stops above price structure and above the maximum stop distance. What we know is true is that even if we do get stopped out, it's unlikely the market is going higher, and more likely it'll be a non-event session. If we don't get stopped out, there's a good chance that the hedge theme will play out with a corrective trade against the underlying trend. Even though the initial stop above price structure is hit, the maximum stop distance keeps the sell R breakout strategy in play. After price breaks back under the alert distance, it's a sign of weakness that the corrective trade may be ready to play out. If so, the market should start building negative price structure and begin trending lower. The stop on the resell can be tighter, as in this example, above the variance, as the expectation is that if the trade's going to work, it'll start trending. If not, soybeans are in for a non-event. Not thinking and maintaining a fact focus on the dominant theme improves conviction to let a trade play out and pay out. The long gilt has the same structure bias in a bear trend, so the more interesting opportunity is a hedge strategy by R breakout. For trend type market states, the R equal directional is an aggressive position which basically is saying, prove it to me. If you're really going to trend lower, price action will maintain a trade below the directional R and work negative structure. If not, then there's the potential for a corrective rally on a breakout above the R level. Right off the open, the market plays its hand and trades above the positive alert distance. This does not mean the market cannot trade back down through the negative alert distance and even down to the DP. It just takes away from the optimal theme and the likelihood that the market is going to perform to the expectations of a bear trend, and is however more likely to have a corrective rally. The key signal to this scenario is that the market instead holds positive price structure. That is a behavior that must be true to keep the hedge theme in play. In this example, the basing above the directional R level with price structure at the figure provides an opportunity to put a third unit on with low risk, using a half, a full, and 2 APMDs as targets. Price alignment with structure will provide good risk-defined opportunities to put on additional leverage and maintain a 1-to-3 risk-reward ratio even with a half APMD target. The expectation is that the hedge theme is going to dominate and produce a corrective rally into the close. As long as the market is performing to expectation, there's no reason to think otherwise. After the CR plus VIR is breached, it's a fresh positive signal for an add-on trade to the original position for a 1 unit targeting a full APMD and using a stop below the CR plus VIR metric and adjusting the original stops up. As the market continues higher, the original 1 APMD limit is filled. The market then holds the UP alert distance metric. Is that it for the rally? To protect our profits, we can raise our stops up to the UP minus AD metric, which also has price structure alignment. The 2 times APMD trail stop is also adjusted, but below the CR plus VAR. As often is the case, the tight trail stop is dinked out, but the longer 2 times APMD trade is in it to the close. Incorporating proper size management allowed for this trade to capture the bulk of the session move, and the clarity of the market performing to the expectation of the hedge theme provided conviction to stick with the trade. The Russell 2000 has a DIR R structure bias, but it's in an accelerated trend state. Knowing the facts associated with this state and structure bias are key to standardizing your trade plan and optimizing your tactics. A market in this state has produced a major positive technical signal, which will follow through immediately if valid. Positive market structure is expected to steepen with negative pullbacks shortening both in size and duration. The key tell for follow-through potential of the signal is the market holding positive structure. Many technical systems have produced positive signals, and the market should just go. If not, the prior period's move may be it for the positive excitement, with a break in structure signaling a digestive trading condition. For the structure bias, the R level equal to the directional poses a challenge to the signal and is the most aggressive sentiment bias position for this signature state. If the higher move high, higher move low posture is going to steepen, the R level will support any weakness. If not, a failure from the directional R level represents the first structure break in momentum, which if confirmed below the downside pivot has the potential to produce a significant counter-trend negative signal. The initial move produces a positive bias and triggers an optimal buy-R fade strategy, which results in a 1 APMD move up to the upside pivot. As pivotal traders, we're more interested in a sell DIR breakout hedge theme, but must view the market from its facts and not what we want to see. Fact is, the market confirmed a positive signal and is in an aggressive positive market state, with an optimal strategy theme that's still in play above the maximum stop distance. Fact is, the market did break structure by trading below the CR plus VAR metric, which negates the aggressive buy structure and puts the market in a more digestive position. Is the sell DIR breakout hedge theme signal still valid? Yes, it is, but at the moment so is the buy-R fade optimal strategy, using a maximum stop distance stop. If you were running both optimal and hedge strategy themes with an automated system, there would be a point where the strategies would cancel each other out, and only after one was stopped out would there be a position. For a hedge strategy theme, the break under the negative alert distance is a negative signal. In this trade, the expectation is for a fast negative turn. Risk can be tight because if the market's going to turn, it should be emotional and fast. If not, it's more likely the market will fall back into a firm digestive trade. In the example, I used the most conservative stop placement in terms of giving the market the most room to succeed, with the variance as a stop and the maximum stop distance on the second, as the market should not trade back above the DIR variance in this example. Knowing the facts associated with the underlying conditions allows you to adjust your tactics to what you know to be true. Fact is, the market is in a bull trend acceleration market state. Fact is, the aggressive positive structure is broken, signaling either a hedge or non-event strategy theme. Fact is, the negative structure of the hedge theme is broken, identifying that the market is in a sideways non-event session. Fact is, the underlying foundation for the market is bull trend. And fact is, the market is trading above the R level with a positive bias, making buying breaks above the directional R level valid with a 1 APMD trade objective. These examples show how standardizing your method to a specific structure bias provides the basis to optimize your tactics and create a more systematic trading approach. For more information on the JS desktop and analytics, please visit our website at JSServices.trade or contact us at info@JSServices.com. I look forward to working with you.